Two pensioners, both 67, both receive exactly £20,548 a year. Same income, same age. One pays £0 in tax, the other pays £1,596. Same country, same rules, and yet a gap of £1,596. Now, your first instinct is probably to ask what the difference is. Is one of them richer, getting some kind of special deal? No, the difference comes down entirely to where their extra income comes from. One draws from an ISAR, which produces tax-free income. The other draws from a private pension, which is taxable once your personal allowance runs out. And with a full state pension of £12,548, eating up nearly all of your £12,570 personal allowance, even a modest second income gets taxed from practically £1. That's the mechanism. But here's the part most people miss. The pensioner paying £1,596 in tax may actually end up better off over their lifetime. Once you factor in the tax relief they received going in, and the employer contributions they collected during their working years, and the ISA saver paying no tax in retirement, they built that pot with money that was already taxed. So the real question is not who pays tax today, it's who ends up with more money over their whole life. I'll show you the full picture in this video, including 3 specific steps you can take right now to reduce or even eliminate that tax bill. If you're a UK pensioner or approaching retirement, hit subscribe, because understanding this one difference could save you hundreds, or even thousands, a year. The full new state pension for 2026-27 is £12,548 a year. The personal allowance, the amount you can earn tax-free, is £12,570. That leaves just £22 of tax-free headroom for any other income. So if you have a private pension of £8,000 on top of the state pension, only £22 of it is sheltered. The remaining £7,978 is taxed at 20%. That comes to £1,595.60, rounded to £1,596. Now you know exactly where that number comes from. If instead that £8,000 comes from an ISAR withdrawal, the picture is completely different. ISAR income doesn't count as taxable income. You receive it and hmrc doesn't touch it. So the gap between the two pensioners in our example isn't really about tax rules being unfair, it's about the source of the income. But here's where it gets confusing for a lot of people. The state pension doesn't come with a tax deduction attached. DWP pays it gross. hmrc then adjusts your tax code on any other income, usually a private pension or a part-time wage, to claw back the tax they're owed on the state pension. So if you have a private pension, you may have noticed it being taxed more heavily than you expected. That's why. Your private pension is doing double duty, paying the tax on itself and on your state pension. This isn't a punishment for saving. It's a mechanical consequence of how the personal allowance and the state pension interact, and it catches millions of retirees off guard, because many people assume the state pension is tax-free. It isn't. It's just collected differently. If your other income is small enough, hmrc may send you a simple assessment bill directly, which can come as a real shock if you weren't expecting it. So before you decide that ISAs are always better than pensions, let me show you why that conclusion misses half the story. I used to think the tax on pension income was a cruel twist, until I ran the numbers over a full working life. I was wrong. And I think a lot of people are making the same mistake right now. We keep comparing income in retirement as if that's the only moment that counts. But the real question is, after everything, contributions, tax relief, growth, and withdrawals, which route actually leaves you with more money to spend? Let's run through a simple example. Assume a worker earning £50,000 wants to set aside £8,000 of their own money each year for 20 years. That's a personal outlay of £160,000 via pension. That £8,000 gets basic rate tax relief added, taking it to £10,000. On top of that, a typical employer match of 3% of salary adds another £1,500 per year. So £11,500 a year is going in, not £8,000. Over 20 years at 5% annual growth, that pot reaches roughly £400,000. Via ISAR, the same £8,000 goes in after tax, with no relief and typically no employer contribution. At the same 5% growth over 20 years, the pot reaches roughly £280,000. That's a £120,000 difference before either person has taken a penny out. Now, in retirement, the pension saver faces income tax on withdrawals. But they also get a 25% tax-free lump sum, which on a £400,000 pot is £100,000. The remaining £300,000 drawn down over time is taxable. But here's the point that gets missed. The tax they pay in retirement is in many cases simply the government recovering part of what it gave them up front, and they still come out ahead, often well ahead. The ISAR saver, zero tax in retirement, but zero tax relief going in and no employer boost either. The apparent fairness of paying no tax at 67 was paid for by leaving £120,000 on the table during the accumulation years. So when someone says, "I'd rather have an ISAR because I won't pay tax in retirement," that's a valid feeling. But it doesn't reflect the full math. The pension is still the more powerful tool for most people. The next question is how to structure your withdrawals so the tax in retirement is as small as possible. Let's make this concrete with a £100,000 private pension pot. You retire at 67. You take the full 25% tax-free lump sum. That's £25,000 in hand. The remaining £75,000 goes into drawdown. You then withdraw £8,000 a year from that drawdown pot to top up your state pension. As we've seen, almost all of that £8,000 is taxable. You pay £1,596 in tax each year. Over 10 years, that's nearly £16,000 gone, not to you, not to your family, just to hmrc. Now take the second path. Instead of crystallizing the whole pot at once, you crystallize small amounts each year. Each time you crystallize a chunk, you take 25% of it as tax-free cash and leave the rest in drawdown. But crucially, you only draw taxable income up to the level your personal allowance allows. For the first few years, you might live entirely off the tax-free cash, deferring the taxable portion until you have less other income or until the personal allowance has absorbed what it can. This is called phased crystallization. It's not complicated. It's simply choosing how much of your pot to unlock each year rather than unlocking the whole lot on day one. Done carefully, you can reduce your annual tax bill to zero, or very close to it. Now, that £16,000 you saved over 10 years, if it had stayed invested at a modest 5% annual return, it would have grown to over £20,000. That's a proper holiday. A new car. A meaningful gift to someone you love. People who sequence withdrawals intentionally keep more. People who don't tend to find out the hard way. Not everyone has a straightforward drawdown pot. A large number of people approaching retirement have a defined benefit pension, a guaranteed income for life, either from a public sector job or from an older private sector scheme. The average private sector DB pension in payment runs to around £4,500 a year. So let's say you receive that. State pension of £12,548 plus a DB pension of £5,000. Total income, £17,548. After your personal allowance of £12,570, the taxable portion is £4,978. At 20%, that's just under £996 a year. Not the headline £1,596, but still nearly £1,000 going out every year just because of how your income sources are stacked. The unprepared person takes the DB pension as it comes, doesn't give tax a second thought, and pays £996 a year. After 10 years, they've paid nearly £10,000 they didn't have to pay. The prepared person looks at the full picture. If they also have a DC pot, say £50,000, they can take £12,500 of tax-free cash from it and use that as their spending money for 2 years instead. During those 2 years, they're not drawing additional taxable income, which means the DB pension is effectively absorbed within the personal allowance. They've deferred the tax, bought themselves time, and kept more in their pocket. It's also worth checking whether the marriage allowance applies. If your spouse or civil partner has income below £12,570, they may be able to transfer £1,260 of unused personal allowance to you, saving £252 a year, with backdating available for up to 4 years. You don't have to accept the tax bill as inevitable. Small changes in sequencing can save thousands. Imagine sitting with your annual tax calculation and seeing a bill for £1,600. Now imagine watching it disappear, legally, using tools you already have access to. That's not theoretical. That's what good sequencing looks like in practice. There are 3 levers. Let me walk through each one. The first is phased tax-free cash. Instead of taking your full 25% lump sum on the day you retire, you crystallize your pension in small chunks each year. For example, you crystallize £10,000, taking £2,500 as tax-free cash and leaving £7,500 in drawdown. You use the £2,500 to top up your income. No tax due on that portion. The £7,500 stays invested. If you have a £200,000 pot, you can take £2,500 tax-free each year for 20 years. That's £50,000 entirely outside the tax system. The second lever is the marriage allowance. If your spouse or civil partner earns below £12,570, perhaps they have only the state pension or a partial one, they may be able to transfer £1,260 of their unused personal allowance to you. That reduces your taxable income and saves you £252 a year. You can apply for free on gov.uk, and you can backdate the claim by up to 4 tax years. If all 4 years qualify, that's over £1,000 back. The third lever is timing your drawdown around your income gaps. If there's a year when your income is lower than usual, perhaps before your state pension starts, or after a part-time job ends, that's the right time to take a larger pension withdrawal. You'll use more of your personal allowance efficiently, pulling income out at a lower effective rate rather than letting it pile up in future years when you may have less flexibility. None of these steps require a financial degree. They require knowing they exist, and then acting on them before the tax year closes. If this kind of practical planning is useful to you, subscribe to Arthur's UK Retirement Guide. We cover exactly this: real decisions, real numbers, no jargon, every week. I know what some of you are thinking right now. You're angry. You saved. You contributed for decades. You did everything the right way, and now you're being taxed on your pension while the other people receive benefits and pay nothing. That anger is completely understandable. I've been there too. When I first started drawing my private pension, I got a shock tax bill I wasn't expecting. I felt furious. It felt like the system had moved the goalposts after I'd already played the game. That feeling is real, and it's shared by a lot of people in your position. But I want to be honest with you about where that anger leads. It doesn't reduce your bill. It doesn't change the rules. And if it stops you from sitting down and doing the planning, you end up paying more than you have to. The taxman doesn't care how you feel. He just processes the check. So instead of fighting the system, learn to work it. Every pound you keep through smart sequencing is a pound hmrc doesn't collect. That's the real answer to the unfairness. Not the anger, but the action. The pensioner paying £1,596 in tax isn't a victim of the system. They're someone who hasn't yet optimized their withdrawal strategy. And now you have the framework to do exactly that. Phase tax-free cash, the marriage allowance, if it applies, and timing your drawdown around your income gaps. You don't need to be a tax expert to use these. You just need a few clear principles and the awareness to act before the tax year closes. If this video opened your eyes, hit subscribe and turn on notifications. Next week, I'll show you exactly how to sequence your pensions, ISAs, and savings to pay the least tax possible using a real client case study. Share this with someone you know who might need to see it. Thank you for watching.